Welcome back to Financial Fundamentals, where we break down money concepts so they actually make sense. Today, we are talking about something that most people have never thought about and probably never expected to deal with. Your employer just handed you a promissory note instead of cash. Maybe it's for a bonus, maybe it's part of your compensation, and you're sitting there thinking, what even is this? Is this good? Is this bad? Should I sign it? By the end of this video, you are going to know exactly what a promissory note is, why a 10-year term is a big deal, what questions to ask before you accept anything, and what red flags to watch out for. You're going to walk away actually understanding this thing, not just nodding along hoping for the best. And honestly, the fact that you're here, looking this up, trying to understand it before you sign anything, you're already ahead of most people. This stuff is not taught in school. So let's get into it. Alright, so first things first. What even is a promissory note? Think of it like this. Imagine your friend borrows $50 from you, and instead of paying you back right now, they hand you a little piece of paper that says, I promise to pay you back $50 plus $5 in interest by December of next year. Signed, your friend. That piece of paper is basically a promissory note. It's a written, legally binding promise to pay a specific amount of money on a specific schedule. Now, instead of your friend, imagine it's your employer. And instead of $50, it's $50,000. And instead of December of next year, it's 10 years from now. That's what we're dealing with. And that changes things significantly. Let's break down the parts of a promissory note so you know what you're actually looking at. There are a few key terms you need to know. First, the principal. That's just the base amount owed. If the note says $50,000, that's your principal. Think of it as the original slice of pizza before anything is added on top. Second, the interest rate. This is the extra amount the borrower, in this case your employer, agrees to pay you for the privilege of holding onto your money over time. If the interest rate is 4% on $50,000, that's $2,000 per year they owe you on top of the principal. Third, the payment schedule. This tells you when you actually get money. Is it every month, every year, or just one big payment at the very end of 10 years? That last option is called a balloon payment, like a balloon that keeps growing and then pops all at once at the end. Fourth, the maturity date. That's the finish line, the date when the full balance is supposed to be paid back to you. And fifth, the default clause. This is the part that says what happens if your employer can't or won't pay. What are your options? What are theirs? Got all that? Principal, interest rate, payment schedule, maturity date, default clause. Those are the 5 things you need to find in any promissory note before you even think about signing it. Now let's talk about why 10 years is such a big deal. Think about where your life was 10 years ago. For some of you watching, you were in middle school or just starting high school. 10 years is a long time. A lot can change, companies can grow, companies can fail, economies go through recessions, and the buying power of your money changes too. That's called inflation, which just means that a dollar today buys a little less every year. So $50,000 in 10 years might feel like less than $50,000 feels right now. Here's the really important part. When your employer gives you a promissory note instead of cash, you're essentially becoming a lender to your own company. Let that sink in for a second. You're not just an employee anymore. You're also someone who is owed money by this company. And if the company ever runs into serious financial trouble, if it goes bankrupt, you don't automatically get paid first. Banks and secured creditors, meaning the people who lent money with actual collateral backing it up, they get paid before you do. If the note is unsecured, meaning nothing specific is backing it up, no property, no equipment, no guarantee, you could end up with nothing. That doesn't mean every promissory note from an employer is a bad deal. It means you need to understand what you're getting into. You're not just accepting a paycheck. You're making a financial decision with real risk attached to it. Okay, let's pause for a quick check-in. So far, we've covered what a promissory note is, what the key terms mean, and why a 10-year term comes with real risk. Does that make sense? Good. Let's keep going. Now, taxes. I know, nobody's favorite subject, but this one is genuinely important because getting it wrong can cost you serious money. Here's the thing about promissory notes from an employer. The IRS does not always say you'll pay taxes when you get paid. Depending on how the note is structured, you might owe taxes in the year the note is issued, even if you don't see a single dollar for 10 years. There's a section of the US tax code called IRC Section 409A. You don't need to memorize that. But what it means is that deferred compensation, which is basically money your employer promises to pay you later instead of now, has very specific rules. If those rules are not followed correctly, you could face steep penalties. We're talking an extra 20% tax on top of what you already owe. And there's another wrinkle. The IRS publishes something called the applicable federal rate, or AFR. Think of it as the minimum interest rate the government says you have to charge on notes between related parties, like an employer and an employee. If the note's interest rate is too low or zero, the IRS might calculate what you should have earned in interest and tax you on it anyway, even if you didn't actually receive it. That's called imputed interest. This is genuinely complicated tax territory. And I'm not going to pretend it isn't. This is one of those situations where talking to a CPA, that's a certified public accountant, or a tax attorney before you accept a promissory note is not just smart, it's really important. All right, let's do a worked example so all of this clicks. Remember, this is an example to help you understand the math. It's not a prediction of what will happen to you specifically. Let's say your employer offers you a $50,000 bonus, but instead of cash, they hand you a 10-year promissory note at 4% simple interest. Simple interest just means they calculate the interest on the original amount each year, not on a growing balance. So, we start with $50,000. 4% of $50,000 is $2,000 per year in interest. Over 10 years, that's $20,000 in total interest. So at the end of year 10, you are owed $50,000 plus $20,000, which is $70,000. Now that sounds nice, but here's the catch. You're waiting 10 years for any of that money. If the company struggles, if it gets sold, if it closes, your access to that $70,000 is in serious question. And remember, inflation. $70,000 in 10 years might not feel like $70,000 feels today. Now compare that to negotiating a 6% interest rate with annual interest payments of $3,000 every year. That means you start getting cash right away, $3,000 per year, instead of waiting a decade for one giant payment. That's a meaningfully different deal, even if the principle is the same. So the question is never just how much do I get, the question is, when do I get it? What's the risk I don't get it at all? And what are the tax consequences along the way? Let's talk about your negotiation options, because you do have them. You can ask for a higher interest rate. You're taking on risk by not getting cash. You should be compensated for that risk. You can ask for collateral. That means the note would be backed by something, company property, equipment, something with real value. If they can't pay, you'd have a claim on that asset. You can ask for an acceleration clause. This is a term that says if the company gets sold or if you're terminated, the full amount becomes due immediately. Without this, you could leave the company and still have to wait years for your money. You can ask for periodic interest payments instead of one balloon payment at the end. Getting some cash along the way protects you if things go sideways. And you should absolutely look out for red flags. Vague payment terms. No interest or below market interest. No remedy for default. Language that says future lenders get paid before you. And especially, any pressure to accept a promissory note in place of wages you've already earned. In many U.S. states, paying already earned wages with a promissory note instead of cash is actually illegal. Okay, before we wrap up, I want you to think about something for just a second. What's the one thing from today that surprised you most? Was it the tax angle, the bankruptcy risk? The idea that you'd be lending money to your own employer? Think about that for a second, because that moment of surprise is useful information. It tells you exactly what to bring up when you sit down with a CPA or an employment attorney before signing anything. Let's bring it all home. Here's the single most important takeaway from everything we just covered. A promissory note from your employer is not the same as getting paid. It's a written promise to pay you later. And promises, even legal ones, depend on the other person's ability to keep them. Know the terms, understand the risks, ask hard questions, get professional eyes on anything you don't fully understand before you sign it. If this video helped you make sense of something that felt confusing, I'd really appreciate it if you liked it. It helps other people who are in the same situation find this channel. And if you have a friend or a coworker who just got handed one of these notes and has no idea what to do, share this with them. That's exactly who this channel is for. If there's a money concept you've always been confused about, Drop it in the comments. We go through every comment, and your question might become the next video. That's the whole mission of financial fundamentals, making this stuff actually make sense for real people. This video is for educational purposes only and is not financial advice. Markets and investments carry risk, including the possible loss of principal. Always do your own research and consult a licensed financial professional before making investment, tax, or money decisions.